Okay, we're recording and it's November 21st, 2024. I'm Tim Quast, and this is the Market Structure Edge live demo and discussion. We call it both. You know, we always try to hit some high points about how to use the platform, but it's really a discussion about the tactics and strategies that you can make use of with the data from Market Structure Edge. And with me today are Brian Wilson, market strategist, and Henry Howard up there next to me on the screen, who's the head of client services. And we'll just split this up. So I will kick off the first half and cover several points that I want to share with you, and then Brian and Henry will improve the quality and outcomes by taking the second half. So let's see here. I'm going to share my desktop, and you will see my screen, and this is the Edge dashboard. I happen to be looking at TGT here, and I'm going to come around to that. It's one of the things I want to talk about today. And if you're new to Market Structure Edge, and you veterans, if you just bear with me for a moment, because you know the repetition gets old for you, but it's a good form of emphasis. So Market Structure Edge is built, it's a quantitative data platform. It's predicated on market structure. It's a jargon term, but it means how we think of it. It's the rules, mechanics, behaviors of money behind price and volume. It's how the stock market works, and it's very mathematical. I just hosted a session with one of our chapters of my professional association for the investor relations profession, where we were talking about what's behind volatility around earnings. Big concern for public companies, and core to it it's not, oh, we missed our estimates, or revenues came in light. Those things have an effect, but it's not a rational response to those things that's causing it. And the data and the math tell us. We can literally measure how quantitative money, machines that trade long and short, are much larger effects on how prices behave. So then it's important for those of us who are traders and investors to have some baseline understanding of those things so that we can navigate these markets successfully. So I want to show you, I've got three things that I'll cover today, if I don't forget. One is I want to take you to daily trading ideas and show you some of what is manifesting here, and perhaps why, how it's very difficult to accurately use, and look, I'm telling you this because I think it's difficult, our data to trade around earnings. Because you don't know what's going to happen. I'll give you a couple of examples there, and then I'll share with you what I have been doing, and maybe if I have a chance before the market closes today, what I might do again. And it has to do with where the market currently is and what's occurring in it. So here is daily trading ideas. We share this content via Interactive Brokers as well. The whole platform, though, you can see everything. I have a mega caps portfolio. I can see that the demand is coming down, supply is rising. These 115 stocks, 80% of market cap. So what they do is pretty important to the overall market. Clearly, doesn't mean the market's about to fall apart. I mean, you look at this long downtrend on the supply side, that's short volume. Short volume, we call it supply because the market depends on it, but it's very volatile. It's like prices. Short volume and prices are very volatile. Demand is not a volatile read because money ebbs and flows, and there are more than one reason for that. But if you look at falling demand and rising supply, you know that there's going to be a greater likelihood that the market declines. Now, it's not a metronome. It can be up during the day and down during the day, but it's a central tendency. So going to daily trading ideas, the smaller data set where we screen highly liquid stocks. We apply a bunch of measures behind the scenes, and then these are things that one can trade with a much higher probability. We calculate a probability. Nothing is 100% guaranteed. All the probability will tell us is that over the trailing 90 days, when these conditions existed, this supply-demand divergence, and there are other things in here, what happened? Did this stock give you an opportunity in 1 to 5 days to make 2% or more? And in the case of MicroStrategy here, it did. It's not difficult to see that MicroStrategy is doing well, but it's interesting that it's showing up in our momentum portfolio and very close to 100 billion in market cap. That's quite something. But here's the two things I wanted to show you here today. One is it's telling what's in this portfolio currently. If you have used Edge for any length of time, you know when MicroStrategy, Snowflake, Spotify, Twilio, GameStop is in here. Robinhood has been a regular visitor to this portfolio. When these stocks are in here, it's a frothy period. It's when things that tend to garner a level of enthusiasm. You could say meme stock like behavior are manifesting. That's not necessarily great. But I look through all of them. Do the principles still apply? What we try to do is we say you want to have an entry range and an exit range and a probability, and you want to know what the volatility is. There are various ways to measure volatility. You could say average true range. I don't know how similar that would be as a technical indicator to what we do. We take the high and the low daily price, and then we take a 5-day read of the spread between those to calculate volatility, because that's what machines will do. Machines that are setting prices are going to look at in the trailing data, what are the risks, and calculate returns. So at MicroStrategy, I think it's down 5% or so today, 5 or 6%, but that's only half of its volatility. It's not unusual. And there could be opportunity there. I do want to give you context here. So it's just interesting to see that is the kind of stocks it's interesting to see the kind of stocks that are showing up here, and they're of a particular sort of cast, and it doesn't change the math. It's merely an observation. I like to, when supply and demand in the broad market are diverging, this is just a great thing to do, and it's very easy if you recognize that you have to take some volatility risk. If you're going to put in, let's suppose that you bought MicroStrategy somewhere above 440, we'll call it 448, but not higher than 490, that there's a probability in the next 1 to 5 days that you would be able to sell that at a 2% or better gain. So what you would have to know is that there's a lot of volatility risk, that if you put some protection in on a stock that moves 11% on average every day the last 5 days, that your stop is going to have to be down. You're going to have to take some risk. Is it 2.5%? Probably, at least. Or you might get stopped out. Machines will come through and they're going to move the price around to try to find stops and limits. And so you have to be aware that risk exists. There is less risk of that when broad sentiment is rising and demand supply is falling. Here, I'll show you what I mean. So if you click through MicroStrategy, you will see this graph that will show you the incredible amount of demand that it's had, and it will show you the high and low ranges in here, just so that you can see there's a lot of opportunity to profit on that volatility. That's what we're taking advantage of. And that generally here in the last number of days, supply has declined. It dropped pretty sharply yesterday. So I'd look at that and say, that's a pretty good opportunity. Yet, what diminishes the probabilities are if you see this up here where it says broad market, you can do this every time, and you always should. Always check to see it's much like a weather forecast. You may say, well, it's a beautiful day out, and so I'm just going to head out in t-shirt and shorts. Well, you should check the weather forecast, right? You'd never know what's coming. And the same thing is true in the broad market. The broad market is heavily driven by large passive flows. BlackRock, Vanguard, Fidelity, which is running a lot of ETFs now, Geode, State Street, Credit Suisse, JP Morgan, Morgan Stanley, 47 $47 trillion of assets across that group, and they've run asset allocation models. And so that money is going to wax and wane in the market. Always look at broad sentiment. You can look at this and say, over this basically a 90 trading day view, there's been a long downtrend on the supply side, and demand has spent a lot of time between the red line of 6 and the green line of 4. Only one entry point here. This was a good time to buy if it drops below that green line. And then if the demand goes above the red line, just an algorithm. But if it goes over the red line, there's a higher propensity for stocks to fall or stall. When it bottoms and rises, stocks do okay. When it falls, they decline. Bottomed here. This is the election effect. Big decline on the supply side heading into it. So clearly an indication that maybe the market would do well. And here's where we are now. It is peaked again and supply is rising. So realize that that's occurring. That there's always the risk when supply and demand are starting to converge in the broad market that the market's not going to do as well. It's not an absolute. It's not. There's not this great correlation. It's an indicator. This happens, then that happens. Then the market begins to bottom and stocks take off these green squares here. Options expirations, always got to be aware of those. VIX expirations were yesterday. Public companies shouldn't be reporting like Target when VIX expirations are hitting, because the 20% of market cap that tie to derivatives, if there are derivatives hedges, can go away. We tell public companies to be aware of those risks. But it's a very good way to understand the environment that you're in if you're going to trade MicroStrategy and other things from the momentum portfolio. And all you have to do to go back, by the way, if you go to the broad market, then you just click the momentum button again, and it will take you right back here. So now let me show you what you have to be very careful about. And then I'll talk about this trading strategy and I'll hand off the baton. But if you look at Snowflake, so if we click through and look at Snowflake and its demand supply balance, really good. This was a stock you can clearly capture volatility in. And I've traded it, many times when it shows up in the momentum portfolio. Why not just trade it? Well, I don't know what it's going to do unless I have a good supply demand view of it. There was a lot of shorting, but then a sharp drop in it. This is probably stock that is being created under market rules. Market makers are exempt from having to locate shares to short if they're engaged in bona fide market making. It's part of what the SEC has ceded to the broker dealers who perpetuate a continuous auction. They're going to have to square the books, but you could go back and say the same thing happened here. There was an opportunity to make money. Then at some point, that's going to have to get cleared from the books. But the point is there's strongly divergent demand and supply. Demand strong, supply decline. That's why it's in the portfolio today. It's and it just dropped back below the 50% level. We don't like to see stocks with over 50% short. Doesn't mean they're not going to do okay. It just means there's more artificial volume than there is real volume, and you just want to be aware of that. And so here's the thing. I mean, if you went and looked today, they reported results, and the stock. Let's go take a look at that. I think it's up like 30%. Right there it is. 32%. Would that data have indicated that would happen? No. There might be other things that would give us some idea, but it's a reflection of how the market works. How can a stock move 33%? I mean, it shouldn't happen, but it does. And there's nothing in the data that would have told us that was going to happen. So you have to beware. I always say, go and check the earnings calendar before you trade a stock. It would be nice to have owned Snowflake and experienced that, but you don't know that that's going to occur. And then the counterpoint to that would be Target. If I looked at Target here on Market Structure Edge, would I have traded Target? Well, certainly not. But would I have known that it would drop 22%? No. You look at the data right beforehand, you have high shorting, 66% short during November options expirations, and demand rising but weak. I'm certainly not going to trade that. But these data would not have told us it would drop 20%. I mean, I certainly believe the quantitative money that was bet short, and they have already covered. But the point is, you can't trust looking at these data, the conclusion that you might draw that would tell you which way it might go around earnings. So I always caution that's not a great way to me to use Edge. It is far better. You want the highest probabilities that you can possibly get. So that brings us to the third point. So there are times, and I don't do it very often, but there are certainly times when I will trade the market short and try to capture the fact that the supply demand balance will let you know which direction the market will have a central tendency to go. And then volatility. There's a lot of volatility. SPY moves about 1% every day. The stocks comprising the index that SPY tracks move over 2% every day on average. Momentum stocks move 3%. That's why we're after 2%. If you can capture 2% of a stock that has 3% or more volatility, it's a high probability trade, particularly if you know A, broad sentiment is diverging. B, you've got probabilities and entry points for the stock. C, options aren't expiring. It's not reporting results. What's the probability under those conditions that you can produce very consistent gains? Really good. Then there are also times like this where, here in the last few days, I know now that the broad market is above the red line. Red line, I mean, if you ran the data, we do it. If you ran the data back all the way over the entire data set, the market delivers negative returns when broad sentiment is above the red line. If you add them all up, it'd be a negative number. It's what we do. So I know that the probability that the market would decline is very high in here. Even if this is just the closing price, what's the volatility intraday, like today? I was saying to my wife, Karen, she said, I said, I'd like to trade, but I can't. I'm too busy to do this trade, but there's a very high probability that the market drops at some point and sure enough, it did, right? It was like wham, I could have made 3% just like that on my volatility trade. So during these times when I know A, demand is working against me, B, supply is rising, C, options are expiring. We're just out of the expiration cycle for November today, and the market doesn't have much direct, doesn't know what it seems to want to do. If it closes higher today, whoa, is that a compelling reason for me to buy if it's high close to the close? A good reason for me to do this trade. Here's what I like to do, and you can use whatever instrument you prefer. It could be a SQQQ, TQQQ. The tech stocks play a big role. It could be SPXU, SPXL, long or short. The S&P 500. Realize these are leveraged ETFs. They're not meant to be instruments that you hold. I am not embracing nor endorsing them. I'm offering an example that I personally use routinely. So I know these conditions exist. I may say I will take I'll bias my short trade, say 30%, 40% greater than my long hedge. I will buy both because I don't know, right? And then I don't really care. I'm not looking for an entry point. I'm looking for a condition. If the broad market shows me that it may decline and it's higher, then I will buy the 30% higher short position, hedge it with a long position so that if I'm wrong, I'm not going to lose much on that at all because I've hedged my downside risk, and then maybe buy UVXY. I looked at it this morning. UVXY was down 1%. I thought, I had too many things going on today. I couldn't do it. And the next time I looked, it was up 3%. I would have made 4% on that trade. And all I was after was 2, because I know the conditions exist that could help that trade. And now you only do those things periodically. You don't do that in here. Most of the time, the market will have a propensity to rise because its long-term average is 5.4. If 5 is exactly flat, if the market were exactly 5.0 all the time, it would decline. Why? Because there's a spread between the bid and the offer. And the offer is always higher than the bid. So there's the only way for the market to go up is that there is more buying than selling, which seems really basic, but that's measurable. And if they were exactly the same, the market would decline because of the heavy amount of intermediation, 50% of the volume. So only during those periods where I know it's going to have a high probability of volatility and or a decline will I use that strategy that I just described to you. But it recurs, call it once a month, and not every month will that be the right thing to do. But it's nice to know that it doesn't matter what the market is doing. There's an opportunity using market structure, understanding the mechanics. You don't have to do fundamental research. You don't have to look at any technical screens. All you have to know is the broad market supply and demand balance and what the opportunity is. Look at this. I'll finish with this and hand the baton. So here, we were 51% short at the beginning of September, and the market, had a tough time in here to start September, and it went all the way down to 46, and now this trend is reversing. I don't know what that's going to do. I mean, this is a historically low level of supply, but it's reversed. And on the demand side, does this pattern mean that the market's going to break down? I don't know. All I know is that for a few days here, there is probably a short opportunity, and then we'll see. So with that, I'm going to stop sharing and I will hand it off to Brian and Henry.
Results and stability. People first, purpose-driven, performance-focused.
Turn my mic on. Tim, one question for you related to, let's say, MicroStrategy. You were looking at that one earlier. 11% intraday volatility. If you're looking at names like MicroStrategy, for example, that have higher volatility, and you want to potentially buy that, you'll obviously look at your stop limits, but will you approach them in a certain manner? Let's just take MicroStrategy. Maybe you get it when it's down 4% on the day or something like that. Will you approach it a little differently? Your mic is off, Tim.
Thank you very much. Yeah, I would say, for instance, you could compare a couple. You look at WBD, it's up today, and you got MicroStrategy, and it's down, and it's consistently down, and you know that broad market sentiment is declining. I would be unlikely to buy MSTR during the day until very near the close. I mean, why risk the volatility and potential further declines? When you can buy it near the close at down half its volatility. And what you're banking on here is the supply-demand equation is very good, very favorable. And as I've said here on these demos and I've written about, for high-frequency traders, trading is an investment horizon of a day or less. It is an entire life cycle today. Citadel, Hudson River Trading, Quant Lab, Two Sigma, Tower Research, Infinium, GTS, all these firms want to end the day at zero. They don't always get there, but they're going to try. And then they start over the next day with whatever the data are indicating. Well, we have an advantage, right? We know that there's a supply-demand imbalance in these things in the daily trading ideas like MSTR. And so the next day we'll start over. What's the probability that it might not be the next, might be the day after that, but there's a very high probability that MSTR will be up the next day. So your risk is you're holding it overnight. And I know that makes some of you queasy. To me, there's not a lot of risk when there's a Wild West outside market hours, and then market hours resume, and the rules and the access are all the same for everybody. That's what Reg MS dictates. There are 4 tenets to it. There's access to quotes, prices, and data. And so the access is the 4th thing. Everybody's got access to those things. It's not all equal, but then, so you're going to have a shot the next day. Why risk your money all day long in something that's down half its volatility? Now, if something's flat at the start and broad sentiment is rising and supply is falling, buy that, right? If it's right within the trading range, the entry, we give you an entry range, which is really down a third of the volatility to up a third. Prices move a lot. It's very unstable. There's a great opportunity because there's a very high probability that within the next 2 hours, that thing gives you 2%. Why? It's the way high frequency trading works. It's just, the principles of the market. It's how I would answer it.
Perfect. No, thank you. One question came in on the chat related to IBKR, or actually Interactive Broker. Do we have anything with Interactive Broker right now?
Well, so we have this, we've been a content partner with IBKR for better than 2 years. And we built those daily trading ideas as a result of the relationship with IBKR. And if you've noticed, if you've used Edge from Interactive Brokers, you've probably seen I haven't done any webinars lately. I've got one in December, and I'm going to cover taking consistent gains. Yes, we have a content partnership. We're working on some stuff with them. There are some things that we would like to see as part of that relationship. That's all I can say now. But we really like IBKR. That's the platform I use.
Perfect. Could you mention perhaps how you get there to Edge on IBKR if people aren't familiar with it?
So it depends on how you are, if you're using your phone. I trade on my phone more than anything because I'm not looking at charts. It's not what I'm doing. I'm using mathematical probabilities. So, and the functionality on IBKR with your phone is really good. So if you click the markets button, if you access it on your phone, the mobile app, and on the lower right, the markets button, and you scroll down to discover, it's right there. Market Structure Edge, and there are a handful of others. It's really simple. If you're on a desktop, like the workstation, difficult. You have to go to research and then probably search for it. In the portal, you would go to the discover section. And then you'll see.
Thank you.
Yeah.
Henry, could you maybe hit us up with maybe the top thing that you're watching right now?
Yeah, absolutely. The first one is, I'm just going to pat myself on the back. Last week, I went ahead and shared WBD, which is, it took longer than I normally like, but finally sort of had that, as soon as the market continued. It's just looking at WBD. Again, it's been in the daily trading ideas for a few days now. So that's one thing that I'm looking at, how much long, to Tim's point, is how much longer do you stick around? I think we cleared, in my mind, when we think about all of this data, I'm always tying it back to the context. What is the context? Well, we just cleared the bar of volatility expirations. We cleared, like the mid-month expirations. And so between now and the end of the month, there's not a ton of, I'm not seeing a ton of risk off in the context, but to Tim's point, is statistically, this is a time when we go backwards. So that's the couple things that I'm looking at. The other thing, if I'm going to offer you too, and am I going too fast for you, Brian, here? I wanted to mention a second thing is, I look at big tech quite a bit. What I'm curious about, and maybe either of you have thoughts on this, is what I'm looking at is, I use a sort of I take a look at the broader market using this heat map here. Obviously, what sticks out to me is, in the last week, we have Microsoft, Amazon, Meta, Google that are all down. Well, the market's still pretty strong. Well, what do we find in Amazon, Microsoft, Google? Well, they're down. Amazon's down. The only one that's been going up, which is actually up now 9% on the week, is Tesla. So I guess the couple things that I'm looking at, on Wednesday, I mentioned big tech. There's still a lot of active trading behavior, which I sort of, I'm always watching those behaviors to see who are the market participants here. So the point being is that Edge is really helpful, beyond broad market sentiment, is to start to dig down. But, I'm starting to wonder why, curiously, normally when we see all these bigger names down, we'd see the market down. So does that speak to a little bit of a shift in big tech, in how the market's consuming these larger tech names? That's maybe a bigger question than we want to answer right now. But I do want to mention Apple as sort of the last one. Is Apple normally sort of is leading the way, but has been struggling below 5 right now. This is our profiler. I just like using profiler to go back and look statistically. It's like, how does this work? How does Apple, function when we buy a 1 and then we sell the downtick? Well, historically, it's like buy and hold would be 0%, trading it's a 5%. But the point is, when Apple's below 5 over the last 4 months.
And interjecting, Henry, and you only had to trade it 34 of those days, just a third of the days. So then your capital, you can use your capital for something else the rest of the time. Sorry, keep going.
Right. Well, yeah, absolutely. But to that point is that, I'm gonna try to find something that has a little more of a positive return. I'm not looking to buy ones. So I guess the point in all of this is just leaning on, digging down, going from that broad market sentiment, digging into sector, and then going on the individual basis and looking at that individual name. I think WBD, last week we saw that there were a couple of those names like those that looked really strong. So that's the one thing I'll mention, and or maybe that was three things, and then I'll share it back with Brian.
And,
Perfect.
Hey, Brian,
Yep.
one quick interjection on why you're seeing some of this, that Henry, what you mentioned, the market's very reliant on less than 10 stocks. Less than 10 stocks are, 30% plus of the market. And how is it that they could be performing poorly and yet the market continues to do well? It's interesting to see the disconnect between SPY and the underlying basket from a buy-sell balance. I'm not talking about necessarily the performance, but it's another thing that we look at behind the scenes. SPY has had substantially more over the last 20 days net buying days than has the underlying basket. And it suggests to me that some of these large institutional investors are using SPY in place of the basket. So then you have large tech stocks that deteriorate, and yet the broad market doesn't, because you could use a proxy. It's not something you can sustain for long periods of time, but it's interesting. And you can see SPY on the platform too. So just to observe.
No, that's good. Thank you very much. I'll cover maybe two quick topics, and then maybe we can look at the path ahead and kind of talk about that together. One of the topics, I'll kind of circle back to what both of you have mentioned. There's a little bit of a shift right now from a broad market perspective. When you look at what's happening with broad market sentiment, and then you look at what's happening with some of the individual portfolios. And here's what I mean. Broad market sentiment 6.5, so that's still fairly strong. And as we mentioned, that that's starting to move lower, but 6.5 is a very good number. Look at some of the other sentiment on some of these other portfolios. My all equity moving lower down to 5.5. Dow Jones down to 5.4. Large cap very similar down to 5.9. Not quite as much. Magnificent 7, 5.8. You get the idea. Everything's pretty weak right now, except for the S&P 500, which remains pretty strong. So there's a little bit of a divergence in the market, and part of me wonders whether I should consider shorting the Dow Jones at the end of the day. I don't know if that's a bad trade or not, but if you look at the Dow Jones, it's weaker, and right now it's up 1.3%. Like I said, I don't know. I haven't come to a firm conclusion there, but that's certainly something of consideration. Why is this weakening, and we get a strong day today? The whole market right now is in what we call a state of convergence. I mentioned this in the note this morning. It's when demand is weakening and short volume is increasing. We're not at the point yet where you're getting a lot of names for a potential short portfolio. But let me give you a couple of thoughts here. If you like tracking short portfolios, I have two of them that I track. One of them is my Barry short portfolio. That's named for our friend Barry. And I'll just click through this. If any of you are interested, you can take a screenshot here. Like I said, there's not that many names in it right now. Here's the conditions that this one tracks. What Barry is looking at specifically, he's trying to catch them early. So he's trying to catch names that are falling from basically tens and catching that first part when they really start to decline from those higher levels. My portfolio, and I might change the parameters a little bit. What it is tracking, it's tracking it a little bit later in the game. So it's tracking it when it's really started to come under pressure. And it's looking at it when it moves below 4. There's still obviously a lot of room to get down to 1, but just two different ways to think about it. Most of the rest is very similar, but I just wanted to share that with you, especially with us being in a state of convergence. You might start to see, a few more opportunities there. Right now, from a daily trading ideas perspective, I traded today, Henry. I actually made money intraday on WBD. It does get a little trickier trading in this environment. There's still a number of names here, a lot of 100% possibilities. Why does it get a little trickier? Because we're at a market turn. Whenever the market is shifting, we tend to get this dynamic, either when the market's overweight or stretched, or conversely, when the market gets oversold. Both of them tend to be kind of similar. Everything gets a little messy at the market turns. So you can continue to trade. I just tend to reduce my position sizes a little bit, knowing that the market does get a little bit choppy and it does get a little bit more challenging. With that, I'll start the discussion, and then Tim and Henry, feel free to chime in. I mentioned part of it already with the fact that as we look ahead, most of the market's getting close to 5. If the whole market starts to move below 5, becomes almost impossible for the market to post gains. So we do have that dynamic taking place right now. Earlier this morning, most of tech was under a lot of weakness. It's recovered as the day has progressed. But if you look at tech, that's really starting to weaken as well. That went from 7.2 all the way down to 6.2 on a daily basis. And then I guess my last point here is just a consideration for next week. We'll come up to the month-end time frame. It's going to happen during a holiday shortened trading week. I'll share with you what happened at the last month end. Look at October 30th, then look at October 31st. We saw significant pressure when we had end of month options that were expiring. If we get similar trading like that at the end of November, recognize that that's going to occur on a half day. Next Friday will be a shortened trading day. That could be potentially dangerous for the market. I don't expect that that's going to happen, but we are in the middle of holiday shortened trading, and there's always that potential that something like that could occur. And with that, I'll turn it back over to to you and Henry.
I have a curiosity here as we look, and this is a little bit of a longer time frame, and maybe a question for both of you. When I pull up SPY and I look at the opening price at the beginning of the year was about 450 something, and we're up nearly 30%. To Tim's point, it's like we're due for a little bit of a pullback. Now, my curiosity thinking about market structure is if you're sitting on a portfolio that has just done a wonderful year, what are the tax implications of pulling your money today versus pulling your money on January 3rd or whatever it would be? Do you think about those implications on sort of a macro level, Tim or Brian? That's a question that's out of left field. But it occurred to me that we've seen this month, we've had 3 straight months where it's beginning of the month and there's this selling pressure. But as we get through the end of the year, I go, what's going to pressure people to sell off and to negate the fact that we're awash in cash? Is that too much of a question for now?
No, to me, it manifests in supply and demand. Just just as at October options expiration, so ahead of the election, there was clearly people reduced exposure to equities, but they covered shorts. So, and that was very apparent. So then we don't have to wonder, well, wonder what people are going to do. No, it showed up in the data. And I think the same thing applies here. And, edge users, you can look at that. Just watch the broad, and you could isolate by portfolio too. You could, you can look by sector, what's happening in financials. Big financials are deteriorating. So I think it will show up there, Henry. And I don't know. We could speculate on what people might do. But to me, we'll just observe what they do. That's the best thing.
Great.
And then, and you might be thinking, well, what about today? Why is today a giant day? Well, it's the first day clear of the options expiration cycle. So, VIX expirations were yesterday. Monday were new options trading. Tuesday, the banks squared the books. The preceding Thursday and Friday were expiration dates. This is the first day where you find out, well, what are the currents out of that? And I mean, what would cause things to be very strong? Well, that very insufficient level of supply in the market. It doesn't mean, today does not mean that the market is suddenly off to the races. I don't care one way or the other. Certainly, I think about it from a trading perspective, because you don't want to make a wrong trade. But I don't look at today and say, well, it's a surprise to me. One day is not a trend. 2 days isn't a trend. 3 days is a pattern, right? So those are things that are much more important to me. At this point, as Brian pointed out, I look at it and say, well, there's a greater likelihood. There's a very high probability, and so I'll probably do that. There's a very high probability that the market's down tomorrow. May not be. That's why you have to be careful. You can't. I don't like to have an unhedged trade of size, because you don't know. That you can have a high probability that doesn't materialize. So that's what I would say here in conclusion. And I just will continue to watch the supply demand trend into as Brian said, the 28th day, the Friday after Thanksgiving. That's when month-end options expire. We did have one other time. We had a 1,100-point drop on the Dow on the Friday following Thanksgiving, which I think happened in 21, which was November 21 was the last time we had the supply level that we have right now in the broad market. I'm not saying that's going to happen. I'm not predicting it. I have said I fully expect a correction is coming, because we've gone so long without an entry point that sooner or later there will be a reset, and it's just part of market structure.
Mm-hmm.
That's all I've got. Despite our discussion before, we were like, let's try to make this one shorter. With
three of us, that's almost impossible.
Right. I'm the problem. I've never been accused of being brief, so it's my fault. James, I see you. It's nice to see you, my friend. Thanks for joining today. All right. Unless Brian, you can correct my deficiencies there. Should we wrap up?
I think we're good. Yep.
Okay. Oh, Candace, I do want to answer that question. Do you recommend buying at the market open? Realize what's occurring at the open. At the start of the day, high frequency traders are trying to figure out what the supply demand balance is. They're going to swing through to see what kind of hidden order flow there is. Happens kind of midday again too. John, you were pointing this out. That there are almost 3 auctions, and then you got the end of day where everybody needs the reference price. Reference price is basically the last price of the day. That's what you need if you're trying to peg an index. You need that. So those things affect the market. If there's big demand supply divergence in the broad market, you're great to buy at the open, because you probably know there's more buying than selling, right? Otherwise, I'm careful about that.